So pre-COVID in December 19, we thought that the economy would expand by 7.8% between December 19 and December 2022. Now we think it'll expand by 8.5% over that period. So why do we think it's going to be an even faster expansion, despite the fact that that period covers the COVID contraction? Well, I think on the negative side over that period, we've got a long period of very low population growth, reflecting the closure of the borders. We've also got the likelihood of a substantial scarring in the business sector, as many businesses don't make it through that COVID period. And I think we'll continue to see caution amongst the household sector in terms of the risks of any new strains. But of course, there's been some positives over that period. And of course, the big positive has been the government support for the economy, which is around $350 billion based on both federal and state government support. And then of course, we've seen from the Reserve Bank near zero interest rates over most of the period, which of course has brought down mortgage rates and strongly supported the housing sector. We think that'll mean 2.3% strong growth in the December quarter, and then in 2022, 6.4%. Now that's an eye-popping number. The Reserve Bank is expecting 5.5%. What about if we look at it from bottom up? Well, I think the key thing there is the household savings rate. Since the June quarter 2020, the household savings rate has averaged around 17%. Now that compares with normal household savings rate of around 6 or 7%. So per quarter, the household sector has been saving about 10% more of its income than we've seen in the past. And that money is ready to be spent. So over that 2022 period, we're expecting that underlying inflation and wages growth will get close to that 3% level by the end of 2022. And that, of course, is a signal for liftoff for interest rates. So since June this year, we've been expecting that the Reserve Bank would be raising interest rates from the February board meeting 2023, and that remains our view today. So 2023 will be a year of rising rates, falling house prices, and 2024 will similarly be a year of rising rates and falling house prices. However, that household spending profile will still be in reasonable shape in 2023. But what are the risks? The risks, of course, are what the market is telling us, that the inflation and wages story will take off a lot more quickly than we're expecting, making a case for RBA rate hikes a lot earlier, and that rates will need to go well into contractionary territory. That, of course, would significantly change the growth profile, the labour market profile, and of course the house price profile. So these are the risks that we'll be watching as we go through 2022. As with other years, it's going to be very interesting. But I think the most important point is that it's going to be a year of very, very strong growth around our 6.4% forecast.